Hello and welcome to this edition of Closing Trades with me, Aisha Faridi, Avan Dabash with me. And for the market, we're still down about almost 0.5% after what looked like it's going to be one of those quiet sessions. We've dipped from there and then again just been very, very sideways, playing along in a very, very narrow band. L&T is one stock which has been lending support, as are some of the other cap good names. But that aside, there's SBI and Infosys as well, which are some of the top contributors to the Nifty movement today. The Nifty Bank, though, that's where the problem is, because that's off clearly a good 300 points from the day's highs. And the broader markets are once again lagging what the benchmarks are doing. The sectoral losers then, it's media, PSBs, they are the ones which have fallen more than 2% as we speak. So Titan, L&T, your big winners out there. On the flip side, SBI has cracked 3%. Adani Ports down 6.5%, Adani Enterprises down 7.5%, and then of course Infosys, Bajaj Finance, TechM, HDFC Life, a lot of these stocks as well are weighing heavy on the indexes this afternoon. Aman, what are you spotting?
Well, yes, indeed. Those are some of the sectors that are in the spotlight and individual stocks. But when it comes to the broader markets, Aisha, that's where you're really seeing the underperformance, 1.5% off for the mid and the small cap indices. And yes, there are a lot of newsmakers or stocks that are reacting to that kind of news. So you've got a City Union Bank under pressure, Balkrishna, as you said, you've got something like Godfrey Phillips, the entire Adani group of stocks, and even something like a BHEL remains under pressure along with Coforge. On the flip side, though, equal fervor in individual names. Dishman Carbogen, for instance, is up nearly 15%. You've got Spark, which is active. Ditto when it comes to Glenmark, Spandana, Nalco, and Indoco Remedies. Those are some of the buzzers in trade. But just to take our viewers as well through some of the newsmakers then and the stocks that are in the spotlight in today's trading session, largely on the back of news, of course, can't get our eyes off City Union Bank, where the stock is seeing the biggest single day fall since March 23rd of 2020. It's trading below all its key daily moving averages. The company said that there is muted loan growth and additional provisioning, which has dragged the results. They've also cut their loan growth guidance below 15%. Balakrishna Industries as well has seen the biggest single day fall since Feb 9th, 2021, slipping below its 50 and 200 DMA. The EBITDA margin as well has shrunk to a meager 12.5% versus 23% on year. And InfoEdge has seen one of the biggest falls in the last 3 years, the biggest one-day fall, as its numbers came in line with street expectations. But there's been a full impairment of 276 crores from real estate investment, and that impairment is seen in PropTech's investments. There's a high cash burn and uncertainty on the future funding. Well, speaking of City Union Bank, let's quickly hear it out from the management, N. Kamakodi, the MD and CEO.
We were expecting, we should be closing the year with about 15 to 18% and all. And basically, we had been right from the beginning mentioned that we in fact took our legs off the growth pedal just before the pre-COVID. And in fact, we thought that we should accelerate the growth rate from the third and fourth quarter onwards. We were expecting the investment cycle to start from the by December and all. Looks like things are getting slowly delayed. Also, the overall systemic deposit growth is also moderate. So taking into all these things into account, we go slow and steady, and that's why we have been able to consistently maintain our consistency in terms of profitability, efficiency ratios, and things like that. So we will do things we are not comfortable in increasing the growth rate beyond the maybe we thought 15 to 18 should be achievable, maybe slightly a tad less than that. But that conservatism alone has helped us over a period of time, and we want to maintain that, and we don't want to just accelerate the growth just because some of our peers are doing that. We will do things at our own pace.
Okay, let's welcome on board our battery of experts and try and understand what the trading day is looking like so far and how we're likely to pan out in the very near term. Pashupati Advani joins in the fundamentals. We also have with us Kush Bora as well as Naresh Mirani joining in. Naresh, first if I could just start off with you on the trading texture today, where clearly banks are lagging, but you do have support from an L&T, for instance, and maybe to some degree in ITC. But I'm just looking at the stark underperformance in the technology names, in an M&M and SBI, which has cracked nearly 3% today.
So what we are seeing is one day up, one day down across the various stocks and sectors. So there was a day when IT did really well. Today we are seeing a knockoff in IT. Banking did well for a day. Now we are seeing a little knockoff in banking. Mahindra and Mahindra is seeing a result reaction. Overall, one day up, one day down across many sectors, and we end up being at the same place, which is basically 17,800 plus minus 100 points. And that has been the range for the last few days. And it's not just in India, it's globally also. So if you were to pick up a S&P 500 or a Dow Jones, we are for the last 2 weeks in a similar range, very tight range of 2%, 3%. So till now, we've not yet seen a clear breakout out of this range. Once we do that, that would be a confirmation. So we'll be either watching out for US markets to break out, or a dollar index to break down, or the Nifty to break out. Even in the Nifty, what we are seeing is two of the largest heavyweights, which is Reliance Industries and HDFC Bank, have consolidated in a sideways range to or the lower end of the range. So HDFC Bank continues to be at around 1650, where it was 2 years back. Reliance Industries are at 2300, where it topped out in September 20. Now combined weight for these two entities comes to around 25%. So either of them have to break out to give a confirmation. So waiting out for signals from the markets to tell us whether it wants to break out or not. As of now, there are none.
Minus Bank Nifty, which in a sense has been the fulcrum of this market, can the Nifty really go closer to 18,000? Because if the pivot group, which is the banking group, if that is showing signs of weakness, you would imagine that the leadership in the market is going to get punctured further.
So, like I said, in the banking, a single stock like HDFC Bank, the Bank Nifty, in the Bank Nifty, two stocks are worth almost 50% of the index, which is HDFC Bank and ICICI. HDFC Bank is not far away from that 1700, 1720 levels. Whenever that happens, that becomes a leader. We've seen a decent enough correction in ICICI Bank. It's consolidating around that 820, 850 mark. So both these names are pretty much setting up for a bounce, possibly going forward. One is a bounce in ICICI, one is a rally in HDFC Bank. So I would be watching out for HDFC Bank. Whenever that gives a breakout, it could be a change in trend after 2.5 years for the stock.
Adani also joins us. Let's say hello to him. Hello, sir. Long time no see.
Hi, Nikunj.
How things? What's keeping you busy these days? Last we spoke, you were excited about ITC stock going up. Now it's gone further. So you must be feeling very happy and rich.
Well, the thing is that we are. Today is a yawning day. You just go to sleep, wake up, nothing's happening. Market is just trading in a range, and I think that's a general challenge. So, I think one of the other folks mentioned earlier that we are in a trading range. People are scared to invest, and I think that there are some. There's nothing really that we can see that's waiting to take the market up. So that's the thing. So you're saying consolidate, but where is the buying? And then on the same time, you're looking at the Bank Nifty and you're saying how much damage is there as a result of anything to do with the Adani portfolios, whether people have loan against shares or whatever. And there's no clear answer coming from everybody. So until some transparency is there, and obviously the public sector banks have declared what losses they have to the group, but nobody's talking about loan against shares, any kind of other leverage, which would also break into the NBFCs and to the the other companies. So I mean, don't forget, Adani Enterprises was part of the Nifty. So that's it's easy. And then we're not even seeing the ETFs sort of crack down. But again, I think it's a wait and watch all over the world. It's not just in India. And, who knows where we're going to go next. But I think we're going to gradually drift down a little bit simply because of the cost of money. Cost of money has also gone up a lot in the meantime. Nikunj?
Yeah, there is one unique trend today, if I may just flag off, that how companies are reacting to numbers. Info Edge, well, more than anything else, it's the Naukri business, which is the stable business for them. That seems to be slowing down. Obviously, IT hiring is slowing down. Info Edge has just gone to cleaners, 9% lower. This is happening at a time when fintech stocks and consumer stocks are making a comeback. Infosys, just to give our viewers a context here, has investments in Zomato and Policy Bazaar. The second one is Balkrishna Industries. It's a specialized tire company. They export a lot to Europe, and now it's visible that how European demand for the quarter gone by got crushed. So again, Balkrishna Industries, which has done rather well for itself in terms of an outperformance, today just gone down by 11%. So some of these stocks which are there in F&O, they're just going completely haywire. City Union Bank, we've already told you that if the credit growth is going to compress to 10-11%, when the sector itself is growing at 18%, now that's bad news. Pashupati, did you track any one of them? City Union, InfoEdge, or for that matter, even Balkrishna Industries?
No, to be fair, no. But what I have seen as a general trend is that the first half the people had good results, were jumping up and down. The second half people are coming back with lower than street expectation, and the stocks are coming off. So obviously there is something going on. There is a slowdown, which is very subtle and seems to be, according to me, more in the rural areas than in the urban areas. But I think that nobody's immune. And as you're saying, City Union Bank has a large rural book, so obviously they're not seeing any growth in it, and probably seeing some loan losses in it as well. So they're trying to pull back. So this is just me giving a helicopter view. I know nothing about this company per se, as to what it's trying to do at the micro level. But that is what it is. And we're seeing a lot of quote unquote disappointing results, quarter and quarter lower compared to last year, this time lower results, which, was bound to happen. And as I said, it's mainly because of the fact that rates have gone up, and the marginal cost of doing business has suddenly become a lot more expensive. Nikunj?
Look at Balkrishna Industries, because that stock as well was lower by about in excess of 9%. The management clearly after the numbers is stating that there is pressure on volumes, and that's going to continue in the fourth quarter as well. Hasn't seen any signs of resurrection, still lower by 11% on that particular stock price. And the pressure on volumes is going to be largely in Europe as well as the Americas geography, wherein they are continuing to destock. The situation relatively better, they say, in North America, but recession fears continue to impact the demand, and they're hoping for a margin recovery come FY24. Of course, there's been a sharp miss on EBITDA by lower volumes and the decline in EBITDA per kg, which is to the tune of about anywhere between about 11 to 12% on a year-on-year as well as sequential basis. And almost entire benefit of the decline in freight has been offset by lower ASPs as well. The gross margins as well are lower despite the correction that one saw in the raw material costs as well in the quarter gone by, because of the high inventory in the system that Balkrishna in particular was also sitting on. So that's pretty much been the fate and state of the stock today. Kush, just wanted you to come in on the charts of a Balkrishna Industries, the chart of a City Union Bank, both these stocks getting thrashed after their numbers.
Well, very technically speaking, these are like, falling knives. The stocks are reacting to the numbers, and the only saving grace that I could see on Balkrishna is the fact that, it's closing, or rather it's, fairly close to, 2000, where, there's a psychological support. Plus technically also we've seen the stock, hover around these levels before it gave a breakout. So for me, that will be like a make or break number. If you have an existing position, then 2000 is what I will watch very closely. And if that gets taken out, then perhaps a good time to exit the stock. I wouldn't venture, buying this stock just because, it's down right now. Let the dust settle, and that's when, we can consider getting into it. Maybe, depending on where the, final level comes to. City Union, well, and we are seeing a crackdown on this one as well. For me, 140 was a very key support zone where the stock had actually, taken support previously. That's taken out, and the stock sliding further. So same view here. Don't try to venture. Don't try to be too aggressive. Just let the dust settle right now, and we'll take a call when we get to that level, from where the stocks try and turn around.
Okay, gentlemen, stay with us. Lots more to talk about. We'll slip into a very quick break. Still lower by about 63 odd points, 17,800 thereabouts is where we're circling when it comes to the futures. It's the banks which are cracking hard today.
We're in conversation with Pashupati Dilwani, Nourish Murani and Kush Vora. Let's try and understand that, how long this market is going to be moving in this kind of range. Now, those Heidelberg numbers, margins have gone down from 6.9% from 12%. I don't have the details. But I would imagine that the quarter gone by, you had extraordinary spike in crude prices. You had extraordinary, spike in gas prices. Heidelberg Cement is a landlocked company in terms of the capacity. So obviously they would have taken a hit largely with what was happening. Let me get some more details. Normally when you see such a sharp drop in EBITDA, which is not in proportion with the revenue, that really could be some plant shutdown or something else, but I don't want to comment on it. City Union Bank, again, that is the big ISO today. The stock, Naresh, which we've discussed extensively, actually is Tata Motors. One day it is on Kunal's radar, one day it is on your radar, and I'm sure it will come on Kush's radar also very soon. But Naresh, it's over to you on Tata Motors. Kush, then I'm coming to you.
So watching out for Tata Motors because it has already spent almost a year and a half consolidating. After that massive move towards 500, 530 levels, the stock went to a slow drift. All through the negative news over the last 1 year, the stock did not break 380 levels. The last swing high for the stock in December was around 440. We've started sustaining above the 440 mark. So that's our first indication of a possible trend change going forward. So out here, I would be waiting out for the next tick, the recent high which it made post the numbers around 460. Once it crosses 460, that would imply a higher conviction on the breakout playing out. For now, if somebody wants to take a punt, it would be a risk reward buy at current levels with a stop loss at 430. But overall, once it crosses 460 and sustains, that would be a confirmation that the trend has changed. And the whole sideways consolidation of a year and a half is done with. And we again go back to 530. So stock on radar, but the momentum is yet to catch up in a strong way.
Afternoon. I wanted to get in your take on the entire capital goods sector. A lot of these companies are seeing their margins bounce back quite comfortably, some quoting at even levels of decadal highs. And, given the fact that there's been a lot of support as well from the government, we've seen a pickup in execution. Does this space merit a relook? Pashupati, that was for you.
Oh, sorry, I missed that. Can you just repeat it?
I was talking about capital goods, Pashupati. Just, given the fact that we've seen a lot of their margins, the company's margins come in at decadal highs, valuations equally hefty now. We're comparing it to the likes of the FMCG counters as well. But what's your assessment of a lot of these capital goods companies?
So this whole sector is driven by government spending, and so far the government has implied that it's going to spend, and a lot of this has come as a result of either contracts given or contracts expected. So I think it's going to continue, and then there's obviously a lag effect. By the time capital goods kicks in, it's like 1 or 2 years down the road. So it's healthy that we've got it. 2 years ago when COVID started, everybody had stopped and put on hold. Now they're back on the ball. Whether it's what these, you have to have the high Ps because you're spending money while you're expanding. And I think that once these things come online and you start getting revenue out of them, they start looking better. But the
line because that voice is cracking a bit. But in the meantime, let's get in some chart checks going as well. And Naresh, wanted to get in your take as to what the outlook is on, the Adani group of stocks, given the fact that you've got Adani Green, Ports, Transmission and Enterprises under pressure today.
So, like I've always maintained, it is beyond understanding to look at Adani Total, Adani Green, etc. The only places where one can look out for is Adani Ports and Ambuja Cements. Adani Ports has already bounced back quite a bit. So that also goes out of the radar. Now, the only stock out of this whole pack which looks interesting is Ambuja Cement. The reason for the same is the stock used to be 310 to 330 before the whole takeover. The stock has come back to the same levels, made a bottom around 315, 320 a few days back, and today at 340, 45. That's a place where you have a risk reward. The whole Adani premium is taken out. The stock is back at the same prices. Cement stocks from that level in where it was in April 22 have done better from those prices. So in that case, Ambuja Cements looks interesting at 345 odd levels, and one could add more at 320 to 310 with a medium-term outlook. Eventually, this could be a stock which could go back to 420 to 460.
We're talking about capital goods stocks, industrial and machinery stocks. Now, obviously, when you are in an upturn, these stocks will do exceptionally well. But the interesting bit here is that if you're buying some of these stocks now, post a 1.5 year kind of an sugar rush and a strong base now, growth is not going to be 40-50%. So what may happen is that order books will be very fat and the growth will start plateauing because of the base effect. But if you're buying some of these stocks now, you're essentially buying a 15 to 20% growth or maybe 12 to 15% growth in some of the matured businesses at P multiples which are almost like consumer levels. Let's look at the data point. The P multiple for ABB, Siemens, even for that matter L&T, very diversified. So L&T may not be the real comparison, but the other capital goods stocks have P multiples which are north of 50 times 1 year forward. And that just is an indication that some of these stocks are unlikely to be creating a lot of wealth going forward if you're buying them at these levels. Where the base has got completely diluted, I think is in some of the IT companies. Because the base effect now after 2 quarters of disappointing performance now could be drastically different for FY25. Naresh, L&T is a different kettle of fish. But if one has to look at the mid-tier capital goods stocks or the large popular names like ABB and Siemens, are they still in a bull market is what I want to understand. Because if they are in a bull market, Naresh, you need to be a buyer on every decline. You may not make the same quantum of returns, but you will still make money as long as they are in a bull market.
So starting off with L&T, say the whole capital goods segment as such is in a bull market, and it has continued to be in a bull market, even a relative outperformance in the near term. So you can go from L&T all the way down to a microcap transformer company, and they have all done well. Related ancillaries have also started doing well. So anything related to capital goods has been a relative outperformer. Some have been very strong performers. L&T is the one which is most interesting technically. The stock had topped out around 2015 to 2021-22. We gave a breakout about those levels, retested it in the current lows as well as in December. So that base has been set at 2050, and the stock now sets up for a new all-time high. Then you look at Siemens, the stock continues to be near an all-time high. So that is clearly a leader. There is just a catch-up which I think L&T has to do in a big way. Then when you go to the broader markets, TD Power looks interesting. The stock has consolidated well. You have a Bharat Bijli which continues to knock new 52-week highs. Even a small cap, micro cap related auto banks are doing well. So overall, the whole capital goods space looks interesting, and the largest of them, which is L&T, looks the best one as of now.
Capital goods, that clearly has been the space wherein the stocks have seen a stellar run-up in the past 2 years. But could they really be the new FMCG? Purely in terms of the kind of sky-high valuations that these stocks are now commanding. Lisa joins in with an explanation on the valuation math. Lisa?
Well, yes, usually when we think of steep valuation, it is the FMCG sector that comes into our mind. However, of late, it is the capital goods sector that has seen hefty valuations, and they have been trading at about their 5-year average. Well, let's look at companies like Thermax. It's currently trading at 42 times versus its 5-year average of 36 times. Cummins has been trading at around 36 times versus its 5-year average. So let's look at what factors are aiding this growth. Firstly, it is the government capex that has sustained in the absence of private capex in the last 3 years. The capex for railways and roads, that has grown by 77% and 100% respectively. Industrial capex, that has also seen a pickup with select companies like steel that has reached around 80% plus capacity utilization. Make in India, Atmanirbhar scheme, PLI schemes, that has also boosted the investment. In the recent budget, the capex of around 10 lakh crore was announced, which is way higher than the 7.5 lakh crore budgeted on year-on-year basis. And the order inflow has been in the range of 25 to 30% year-on-year growth for 9 months FY23. The margin has seen a decadal high, and the declining commodity prices that will aid the profitability going forward, and analysts are also expecting further cash flow generation. So these are the factors that has led to the re-rating of the capital goods sector.
Much for giving us those details, Lisa. That's the view coming in on the entire capital goods sector, as valuations now are looking rather hefty, and we have seen, of course, a lot of the government capex push as well, aiding the overall fundamentals for the space. Down close to 2%, 1.3% rather, when it comes to the mid-cap end of the market. We're at 17,792. There's lots of action in Bangalore with the 14th edition of Asia's largest aero show, that's Aero India 2023. It was inaugurated by the Prime Minister at the Indian Air Force's Air Base in Bengaluru, with the exhibition showcasing indigenous equipment and technologies to forge partnerships with foreign companies in line with the Make in India vision. My colleague Shivani has all the details on ground. Shivani.
Aero India has begun in Bengaluru's Yelahanka, and this is indeed a runway to the billion of opportunities, because you see a number of companies from around 98 nations are already showcasing their products, their weapons. And here what you see is the stall from Russia and the S-400 missile systems that are being on a display here. And we already know that S-400 missile systems have already been inducted by the Indian forces. They are already deployed, and there are many systems which are under consideration for making in India with the technological transfer from Russian companies. So this is the Almaz Anti-Corp of Russia, where you see a number of defense systems. There are naval air defense missile systems, S-350E, Vichya's SAM system. So these are the platforms that are on the display, which the Russian companies intend to manufacture in India under the Make in India scheme, with collaboration with Indian companies out here. We already know that the Rozo Baron expert from Russia is manufacturing AK-203 rifles in Amethi, Uttar Pradesh, in India. And here what you see is the Ka-226 light multi-purpose helicopter, which is also under consideration for being manufactured in India under the Make in India theme, Make in India scheme of the Indian government. And there are a number of other air defense gun and missile systems that are on a display. This is the Panzer S-1 air defense gun, the missile system that is on display out here, the Tor M2KM. All these weapons we see here on the display in Aero India are the weapons that are of importance in the present scenario, the geopolitical scenario. We see the Russian-Ukrainian war, we see what is happening in North Korea and the different parts of the world as they are turning into the war zones. India is also preparing, and it is collaborating with the companies from Russia, Israel and many other companies. As we say, there are 98 different nations that are in Aero India. They want to make with India, make in India. That will not only improve the capabilities of Indian market, but it will also improve the power of our defense forces and the economy. This is Shivani Sharma with Vijay R.K. Yadav from Aero India, Bengaluru.
Okay, let's move on from the Aero Show currently underway in Bangalore. My colleague Kavita Thapliyal spoke with Shreyas Devalkar of Axis Mutual Fund, who shared with us his insight into the growth trajectory of mutual funds and why they are more attractive to investors.
More than sectors, I would actually call it out. It depends on where the slowdown may hit. The point is that worldwide, all the countries are inviting, so to say, a slowdown to control inflation. So by raising interest rates, so it is going to have impact on something somewhere. So the interest rates which got increased a lot in Western world, so it may be having its impact on the consumption out there and eventually the exports which happens from India. So that portion one need to be looking into detail. So already IT sector has reacted to it in last year itself. But then there are many multiple companies in various sectors which has a component which is export oriented. So one need to be watching out for that. When it comes to India, then one thing which is playing out barring this is because of relatively high base of last year. Some of the sectors may show some slowdown because of that. One need to be very careful in assessing it, whether it is a slowdown or it is just a base effect or not. And based on that, I would like to take a view for this year, and accordingly, it will be more stock specific across the board. So if you take, say, credit growth, which is the largest portion of the segment, of the large cap segment, because credit growth comprises of almost outlook for almost 30% to 40% of the large cap indices.
Start with few stocks which are getting hit because of numbers, poor performance. Info Edge, you got City Union Bank, two stocks which are getting completely smashed because of poor set of numbers. Deepak Shenoy, let's take the conversation forward on why these stocks are suffering. Info Edge, I looked at the numbers, Deepak. Nothing extraordinary bad with the numbers, but the stock of Info Edge today has got completely cleaned out at a time when fintech stocks are making a comeback. Shouldn't it be the other way around?
Yeah, I mean, to be honest, Nikunj, I think the number that they've actually revealed, 287 to 76 crores or something like that, which was invested in this housing or real estate startup, has been written down to zero. That does not mean they'll recover zero from it. It just means that they'll value it at zero until they find a path out or something like that. But effectively, such an announcement actually effectively curtails funding opportunities for the startup itself. So if they're looking for funding, the person who's maybe the VCs they may be talking to will look at InfoEdge's valuation and say, well, if they think you are worth zero, then perhaps we have to, second think our investments and so on. But in general, InfoEdge has been very, very forthcoming on their thoughts. They've, undervalued and revalued Zomato when they were unlisted also at various points in time. So, I think the honesty is refreshing, and their core business is doing well. So the hiring business is doing well. Now, of course, in fact, that's actually the one business that has consistently performed. The rest of them, both their own investments in the real estate listing spaces or in some of the other spaces that they have, and the investments that they have made beyond the Policy Bazaar and Zomato, have not yielded that much in terms of results. So I think, in a way, the valuations that Naukri was getting, which was more than 50% for its other investments, non-core businesses, those I think are getting revalued. So it's tough times, but I think you should appreciate for one level their honesty in telling you as it is as an investor in their business. It's good to know the real story.
We've discussed several times why you like Reliance, and it's a special situation stock. Now things are really firing full cylinders, all cylinders for Reliance, retail business, Jio business, even for that matter their O2 business, because what's happened in the world in terms of commodity pricing is on an uptick. But the stock is underperforming terribly. This year down 10%, last year underperformer. We are looking at levels of 2021, and last 2 years Reliance has been in a range. Why is that?
So, I mean, can't comment on why markets don't seem to give it the valuations that we think in the longer term will come. But it's it's always three different businesses that you're looking at, and perhaps a fourth hydrogen business as well that they're starting out with. And of course, they have the media business. They have it's a bunch of different businesses that kind of are housed in one entity. And that's why you don't know, perhaps apart from their press releases, how these companies are individually financing themselves. They're probably using the financing of the oil and the petrochem giant business that commands relatively low interest rates if you were to borrow, but perhaps the same would not apply to some of the other businesses. At the same time, if they were individually listed, they might actually have a much better balance sheet or profit and loss statement as well. You can't predict what markets will value a business at. Tomorrow it could be just that there are lots of businesses in India which grow at 5% or 6% and are valued at 80 times earnings. Sometimes you can't understand why markets value them at that as well. But over time, the ROE of Reliance has to improve from where it is right now. And I think the only way they'll do that is by eventually demerging into separate businesses. Until that happens, I don't see a hope of a sudden re-rating of Reliance Industries itself. but we are holding on because we think eventually these businesses will be demerged. They will be individually listed, and investors will make the best of all of this. Sum of the parts is greater than the whole right now.
What's your view, Deepak, on the news that came in with respect to Lupin, given that the target action date for one of their drugs has now been delayed? Brokerages are saying that this is seriously going to impact the company, and it has been an underperformer even when it comes to the quarterly performance. More pain in store for Lupin, according to you?
So I don't track Lupin, so I don't know about this arrangement. In general, pharma has been, a disappointment this quarter, but usually it is that pharma has maybe a year or so of disappointment across across the ecosystem. So usually it's a good time to start looking at such stocks. So perhaps I should start doing my homework on these stocks. Perhaps it is a good time to start looking at them. But again, no comments on Lupin specifically. I don't have an idea of the news you're speaking about.
I know it may be a no-go for you, Deepak, but the Adani Group stocks, they're clearly off their 52-week lows. In fact, almost an 82% recovery for an Adani Enterprises. Adani Power has seen a 51% uptick. What's the word of advice really for retail investors who may be still in the stock prices? Sell into this recovery that you're seeing and steer clear?
I would say, I can't specifically advise them to sell or buy because, there is so much unknown, so much of an unknown and uncertainty here that is actually affecting the core business. So, for instance, you would have thought this is only a share price decline, but you're seeing that their business is impacted. There have been some orders from a UP government, smart meters have been cancelled. The total joint partnership on Adani and New Energies has been delayed. They're seeing a different set of demands from the Bangladesh government about the price of energy that they were supposed to supply them with. So given that this situation is actually impacting their business itself, it's difficult to actually now value their businesses, even if you had a valuation matrix in place earlier. Some of the growth numbers, some of the debt, refinancing numbers will all be at a different level. So if they can't refinance their debt at 8, 9, 10%, and they have to refinance them at 15, given the debt situation in those businesses, the recovery in terms of path to profitability for some of them will take a lot longer than it is currently. So I think at this point, given there's so much in flux, if you're holding these businesses, the only way I would say is relook all of them that you hold using the same assumptions that you did when you bought them. And if you don't understand why you bought them, then don't hold them. So I think this is not a time for a person who does not really know these businesses to own these stocks. And even though those who know it, they'll have to reevaluate all their assumptions.
There's one stock which has consistently disappointed. Actually, two. One is Z and second is Delta. Kush, these are stocks which are patronized by traders. Every time they go down, I've generally seen that crowd comes out and believes that the worst is behind Z, worst is behind Delta. It has not created wealth in this entire, it has not created any wealth in the last 2 years. Do you think now we are nearing the end of pain for Delta and Z, Kushwara?
Well, not really Z, Delta perhaps, but not really, Z. There's a lot of hangover. When I look at the charts, there is supply pressure at practically every level, and the stock has not been able to sustain above its 20-day moving average for the good part of, this year and even perhaps December as well. So I don't think Z is a counter that, I'd perhaps look at. There is some bit of recovery. This will probably be used again as, an exit opportunity by, big traders, by big investors, but not something that's on my radar very actively, just yet. Delta Corp, yes, the stock does show signs of rebounding, although it's trading with a consolidation. It's consolidating with a positive bias. My suggestion would be this is one stock that you can look to enter 185, 190 zones where the stock has taken support multiple times over the last 5 to 6 months. Again, we are seeing a congestion zone at about 185, 190 zones. The stock is rebounding. For me, that litmus test for a new fresh up move would be a closing above 210. If the stock is successful in doing that, then I wouldn't rule out a move until 235 and 250 levels also. So between the two, my pecking order would be a Delta Corp and then Z. But then again, if someone really wants to enter Z, Delta Corp still does make for a good trade.
Deepak Shenoy, the minute I would say LIC, it's going to hurt you. I know you own it. But That's where the stock's been. Have you done numbers which would capture the real impact of the budget announcement for a life insurance company like LIC?
So we did two things. Of course, first the idea was they had to announce the results this time for us to understand that they truly were taking a lot of the non-par profits into their account. They have done that. More than 6,000 crores this quarter was transferred. So the run rate is going to be 24 to 25,000 crores as of current. And we believe about 35,000 crores in a couple of years as profit that will be transferred to shareholders. And given that the shareholding part of the organization does not pay any tax, this is pretty much net profit for you. The impact of the announcements on the budget is primarily around the fact that there's no tax advantage to holding policy where you pay more than 5 lakh rupees in premium per year, starting April 2023. I don't think, and I mean, much as we've heard from the management itself, not even 2 or 3% of their policy holders would have premiums of that magnitude. They actually work in the much smaller premium zone. They also have the largest field force in rural tier 2, tier 3, where paying a premium of 5 lakh plus per year, even across different insurance companies, is largely difficult. They don't have the capitalization to be able to pay that much. And a large amount of the people who are paying these LIC policies aren't really doing them for tax benefits, in the sense that even if the new tax regime were to come, I don't think for a lot of these people it's just for saving. It's one way to save. It's a person who is available to them, as an agent who's a distributor or an agent close by who can provide these opportunities. But I don't think tax saving has been a significant part of their tax saving in terms of the ATC kind of saving. For some of them is not meaningful, and even then they would probably take advantage of the old regime for a long time. So I don't think in the near term LIC gets impacted that much. The stock price, of course, is down quite a bit. So we're okay. We in fact increased our allocations recently. However, I think this will take 2-3 years before it resolves itself and the profits start to attract shareholders. Even now they haven't announced a dividend, but maybe in the end of the year they will. I believe longer term that the story is much better here. They're trading at 75 or 80% of embedded value, where HDFC Life is trading at 300% of embedded value. So you're going to see a much lower multiple for LIC anyways. But I don't think the bridge. I don't think the difference ought to be this much. So looking forward to more results to come.
Deepak, I think export businesses like Balkrishna Industries have really taken it hard. I mean, be it the commodity correction, or for that matter, the entire benefit of decline in freights, none of it has worked, and the margins have really been badly hit.
They have, and we own Balkrishna, just as a disclosure. One of the things that happened is also, of course, Europe itself is down. So is a bit of North America. There is, I think one of the problems over here is this is also been a weak time for some of a lot of the other parts of the business as well. They have just commissioned a new plant, which has just come on board. So it's not going to be meaningful in the December quarter, but it will start making a difference in the March quarter. There is also some more capex going on, which is in terms of a new plant, a capex being used for a new plant, and the raw material decreases, at least what management says, have not yet been translated fully to them. So they're seeing a very slow decline in raw material prices. Margins have collapsed quite a bit, so there is a fear there. The stock's down, but it's for the valuation it is being given these valuations for relatively high margins, and we believe once the markets go back, there is possibility that these margins start to come back. But of course, the results have just come, so a lot more analysis needs to happen to understand whether this is structural or whether it's just a cycle, and the company will live through it. We've owned this company for a long time, more than 5 years. So the decline is not something that's loss making for us, but it does call into question a lot of the export businesses viability, especially European export businesses in our view.
Biocon, Lupin. Actually, let's do one thing. And Kush, you may want to just be with me. I'm coming right to you. I just want to establish the 5-year change in pharma. 5-year change. Sun Pharma, Lupin, Dr. Reddy, Biocon, Natco. It's the entire sector which has got cleaned out, with the exception of, to some extent, Cipla, which has a very strong, domestic business. 5-year change in Biocon, down 23%. So much so about biosimilars. I mean, that's how markets are reacting to it. Sun Pharma in 5 years is up 100%, but they are coming off a very sharpish sell-off, which I think happened in 17-18 because of all those confusion which happened in their cross holdings in the real estate. Then look at Cipla. In 5 years, nothing. I don't think Dr. Reddy has also created a lot of wealth. Natco for sure has not created a lot of wealth in 5 years. Aurobindo Pharma has also not created a lot of wealth. Kush, haven't these stocks consolidated for 4-5 years that they should now get ready for launch now?
Yeah, well, the thing about pharma is that it's a very diverse space, right? And there isn't really too much to say that if we point a finger and say that perhaps this is the space that actually ideally should do well. Within the healthcare space, if we can take a broadish view, then perhaps you can find some stocks, but not pharma in general. And again, this is one sector rather that I would say has only been on our radar for, let's say, a trading bounce. So for example, Sun Pharma or Cipla, if you consider, for the last 6 months or so, perhaps we've seen a very decent bounce. But otherwise, on the flip side, something like a Lupin has now disappointed. Divi's continues to disappoint for the last 3 quarters. So that is something that I would say take it with a pinch of salt. They do have an angle of defensives in them, but that doesn't seem to be playing out too well. So for me, this is not a sector that would be on my radar. If at all, then this will probably be a small allocation as a defensive play, but nothing much really. If I were to still pick one stock, you're right. Sun Pharma is something that I would have on my radar. It's not seen a meaningful bounce, and I'm looking at the long-term 5-year charts. It's not seen a meaningful dip, barring the May 2022 kind of time horizons. This is one stock that I would still have on my radar. There is still a lot of upside on this. A fresh entry, 1200 is where I see the stock headed in the next couple of months, and my stop loss here would be around 950. So this is perhaps the only stock that I would look at, other than Cipla, of course.
BTST calls in, just about 4 minutes to go before the markets to wrap up the trading day. Naresh, your BTST bet?
So that would be a buy on NTPC. The stock is trying to give a breakout on dividend adjusted charts very close to that mark of 168.69 where the breakout is. Momentum continues to be strong. A stop loss at 165 and a target price of 173. Second is a buy on L&T, which continues to be the best in the capital goods space. A stop loss at 2180 and a target price of 2250.
Okay, Kush, let's get in your recommendations.
Sure. It's from the space that we've already discussed in the stock that we've already discussed, which is Thermax. The stock is doing well. It's given a breakout, very clearly. And, one of the rare few that's trading above its 200-day moving average. So 2200 would be my target. 2090 would be my stop loss on this one. The other one is Titan. The stock has given a breakout today. And the good thing is it's closing, very close to the day's high. So even Titan would be in the BTST category. 2600 is my target here. And my stop loss here would be, 2500 to 2480 zones.
To go, and it's turning out to be one of those days where you want to mark an absent for the bulls again. Naresh, we are marking a lot of absent for the bulls, right? This must be the longest calendar in which bulls are getting absent every day.
So I think if you were to go back, say a year and a half back, we were almost at the same prices. So it's been absent in terms of the indices for a long time. Overall, also what we see is even on a daily basis, one day up, one day down has been continuing. So waiting for a price action confirmation, like there's a saying, you cannot short a dull market. So we wait for price action to actually confirm the upside or the downside. So we're right at the same prices. So waiting out 17,600 or 18,000.
Deepak Shana, I've got 2 minutes before the markets close. I have one simple point. Whatever could go wrong for market has gone wrong this year. Adani fiasco, commodity prices coming back, FIs are selling, confusion in which way fintech is headed. January was a complete disaster month for fintech and consumer tech. Yet Nifty is still at 17,000. So if anything incrementally positive comes for the market, can we make a case that Nifty is going to go higher rather than lower? Because so far with so much of bad news, Nifty has managed to stay in and around 17,600, 17,700.
That's a very good question, Nikunj. I mean, the thing that I think drives a lot of volatility out of the Nifty is the fact that Nifty futures and options are so heavily traded. So you don't see that kind of lack of volatility for the junior Nifty or for any other of the indexes. Much about, I think, some of our valuations are still sky high, and some other valuations are relatively low, like we've talked about. And if foreign investors were to start putting money back into India, I think markets will start to go up. I think it's as simple as that, because it may not be news driven. It's got to be liquidity driven. Most of the fact that markets went nowhere in the last year is because foreign investors took out 200,000 crores, domestic investors put in 200,000 crores. So net, there's been very little addition to stock market liquidity. Given the new rules that have been coming around from SEBI of perhaps increased brokerage because of their lack of float income generation, given the lack of interest in foreign institutions to put in more money into India, over the last year they've taken out a lot, and in January also they took out 26,000 crores. I think I will await the increase of liquidity from one of these sources before I would say good news drives the market. I think good liquidity drives the market, and we haven't had that for a while.
Right. Okay, Deepak, great to have you on the show as always. Kush, Naresh, we'll let you guys go as well on that note. And we're closing in down about almost 0.5% there at 17,760 on the Nifty spot, 17,800 on the Nifty futures. Glenmark, Nalco, Titan, HAL as well as L&T have been the winners from